All right, let's dive in. We are, truly navigating an unprecedented moment in financial history.
Absolutely.
As of August 1st, 2025, the global markets, they've really hit a critical juncture. So, okay, let's unpack this. Our mission today is to cut through all the noise, the complexity, and really distill the vital insights from this big financial briefing that just landed.
Yeah, there's a lot in there.
Think of it as your shortcut, understanding the why and what it means behind these, seismic shifts.
Exactly.
We're zeroing in on three colossal forces converging right now. First, the Federal Reserve's stance, and crucially, that intense internal debate happening there.
Right, the division.
Second, the full rollout of these new sweeping global trade tariffs, fundamentally reshaping commerce.
A huge piece of the puzzle.
And third, the accelerating, almost dizzying integration of digital assets into traditional finance.
What's truly fascinating here is how all these seemingly separate pieces are not just moving on their own. They're profoundly interconnected. They're creating both, significant risks, but also some really interesting structural opportunities.
They're not just isolated events then?
No, not at all. They're influencing each other constantly. You need that holistic view. Our goal for you today is to understand not just what's happening, but the underlying why behind these big shifts.
And what it means.
And most importantly, what it means for the global economy and, for your own strategic thinking.
That's crucial. So let's start with the Fed. Discord seems like maybe too mild a word.
Huh, maybe.
The Fed just held rates steady again, 4.25% to 4.50%. That's the fifth meeting in a row.
Standard headline looks like continuity.
Exactly. On the surface, yeah. But underneath, unprecedented internal division. We saw two Fed governors, Waller and Bowman, actually dissent.
Right. They wanted a cut.
They both voted for a 25 basis point cut.
Yeah.
This isn't just like a minor disagreement. It feels like a fundamental crack. It's the first dual dissent from board members since, get this, 1993.
Wow, yeah. That's a long time. It definitely harks back to different eras at the Fed.
Definitely.
This raises an important question. What does this level of public discord actually tell us about the path forward for monetary policy?
What does it tell us?
Well, such a rare disagreement, especially from board members, it signals a really complex policy environment. There's clearly an internal struggle.
Between what? Inflation and...
Exactly. Battling that persistent inflation versus growing worries about, economic uncertainty, maybe growth slowing down.
Right.
It implies consensus on the next move is far from settled. And that lack of clear, unified voice, that could definitely inject more volatility into the markets.
Yeah, markets hate that kind of uncertainty. And speaking of uncertainty, if you were looking for clarity from Chair Powell's press conference, well, you didn't get much.
No, he was very guarded.
Offered very little on September rate cuts. He just said flat out, we have made no decisions about September.
Emphasized the data dependency.
Yeah, basically leaning into the uncertainty, saying they need to see the data through the next meeting window.
And markets reacted, didn't they?
Yeah.
Swiftly.
Oh, yeah?
After Powell's comments, those probabilities for a September cut just cratered, went from around 70% down to below 50%.
Wow.
And that shift, well, it had immediate knock-on effects. Strong dollar rally, some choppiness in equities.
Yeah, makes sense. The market wants signals, right? Predictable ones, ideally.
Exactly. And when the world's biggest central bank gets murky, investors adjust fast. It's that old saying, right? The market hates uncertainty more than bad news.
True. And the Fed, they have reason to be cautious. Inflation concerns are definitely still on the table.
Very much so.
Core PCE inflation, that's the one the Fed watches closely, strips out food and energy. It held at 2.5% in June, still above their 2% target.
Still sticky.
And headline inflation, the broader measure, actually accelerated, up to 2.7%.
Right. Powell did mention the tariffs starting to show up in some prices.
He did, but he also said the overall effects are still, uncertain.
Which brings us to the potential inflation path ahead. Analysis from Treasury, it suggests inflation could really pick up speed in the second half of 2025.
As the tariffs bite.
Precisely. As those full impacts work through the supply chains, forecasts suggest core PCE could hit maybe 3.4% by Q3 and potentially 4.3% by Q4. That's concerning.
Yeah, that really threatens their dual mandate, doesn't it? Stable prices and maximum employment.
Absolutely. It forces them into this incredibly difficult balancing act, like trying to gently cool inflation without, freezing the whole economy.
Right. And speaking of those inflationary pressures, they're tied directly to this Well, enormous global trade transformation. That August 1st tariff deadline just passed,
The implementation date?
implementing what many are calling the biggest trade policy shift since World War II. I mean, that's huge.
It really is. The scale is massive.
Get this number. The average U.S. tariff rate jumped from just 2.5% in 2024,
Which was already up a bit.
right, to 17.8% now,
Hmm.
on average. And many trading partners face rates between 15% and, in some cases, 50%. Depends on the deal, or lack of one.
Yeah, this isn't tinkering. It's fundamental.
It really is.
And if we connect this to the bigger picture,
Yeah.
this isn't just about import costs going up. It's truly about reshaping global commerce on a macro scale.
How so?
Think about global supply chains where companies
Yeah.
decide to build factories, long-term investment flows, and ultimately consumer prices everywhere. It's like redrawing the map of economic connections.
A foundational shift. And we're seeing a real mix of outcomes from the negotiations, aren't we?
Definitely. Some deals got done.
Like the EU. They got a 15% baseline tariff, which is better than the threatened 30%.
True, but with caveats.
Right. Exemptions for some things,
Yeah.
but still a heavy 50% tariff on steel and aluminum.
Then you have countries like Japan and South Korea.
Yeah, they seem to have aligned with these huge U.S. investment commitments. Japan, what was it, $550 billion?
Massive. And South Korea, $350 billion. It suggests this new model of sort of strategic economic partnerships alongside the tariffs.
Interesting. UK got 10% baseline, but with quotas on cars and aerospace. Vietnam's at 20%, down from 46%, but with that extra 40% on transshipped goods.
Right, trying to stop circumvention.
And Indonesia, Philippines, 19% tied to other deals like Boeing purchases or military cooperation.
So a real variety of agreements.
But then you have the big unresolved ones, where enforcement is kicking in.
Right. India's facing 25% tariffs already.
Yeah.
Negotiations failed, plus penalties for buying Russian energy.
And Mexico and Canada.
Yeah.
Potential 35% tariffs hanging over them if they don't comply with parts of the USMCA.
It's a big threat.
And China, still in a temporary truce, right? 30% combined tariff, but that truce expires August 12th.
So still a lot of uncertainty there, huge implications.
Definitely. What's the estimated economic impact of all this?
Well, estimates vary, of course, but JP Morgan, for instance, thinks the combined tariffs could shave about 1.0% off global GDP.
1%. That's significant.
It is. And the Yale Budget Lab, they project it could cost the average U.S. household an extra $2,400 per year.
Wow. Like a hidden tax.
Essentially, yeah.
Yeah.
As those costs filter down to consumers.
Yet. And this is the surprising part. Equity markets seem pretty resilient, don't they? The S&P 500 keeps hitting new highs, even as these tariffs take effect.
It is surprising. It suggests the market is either, extremely optimistic about deals eventually being struck, or perhaps more likely, it's already adapting, adjusting its expectations and models to this new trade reality.
Adaptation rather than rejection.
Exactly. A remarkably swift adjustment, actually.
Okay, let's shift gears to currencies. Foreign exchange. Because with all this going on, currencies are definitely moving.
Big time. The U.S. dollar has been quite strong.
On an absolute tear, yeah. The DXY, the dollar index, measures it against other major currencies. It's pushing towards that big psychological 100 level.
Gaining over 3% in just the last month.
Why so strong? What's driving it?
Well, a couple of key things. First, that monetary policy divergence we talked about. The Fed's staying relatively hawkish, or at least less dovish, than many other central banks.
Right. Higher relative rates attract capital.
Exactly. And second, these big global trade shifts are creating safe haven flows. When there's global uncertainty, investors often flock to the dollar for perceived safety.
Like running for cover.
Pretty much. So you have both the policy divergence and the trade uncertainty pushing capital towards the U.S. dollar right now.
And we see this playing out clearly between central banks globally.
Oh, yeah. Look at USD/JPY, the dollar versus the yen. It's surged above 150.
That's near intervention levels for the Bank of Japan, isn't it?
Right up against them. The yen's down almost 5% this month against the dollar. That puts real pressure on Japanese authorities.
And the euro.
Euro-USD has pulled back from its recent highs. The ECB, the European Central Bank, their policy is still seen as much more accommodative compared to what the market expects from the Fed.
So the euro is less attractive, relatively speaking.
Exactly. It makes the dollar look stronger by comparison.
Okay, so while all this is swirling in traditional finance, there's this parallel universe of digital assets. And it seems to be Maturing rapidly.
Quietly but significantly, yeah.
Pig Bitcoin, it's held remarkably stable above $117,000, even with all this other market volatility.
Yeah, showing what some are calling institutional-grade resilience.
Right. It had that huge year-over-year gain, like 78%, but now it's consolidating. Does that suggest it's becoming more stable, less speculative?
I think that's part of the story, yeah. Maturing into potentially a more stable store of value, moving beyond just speculative frenzy, attracting longer-term capital.
And the whole ETF ecosystem seems to be hitting its stride.
Oh, absolutely. Inflows hit, what was it, $4.4 billion during Crypto Week?
Huge number. Ethereum leading with $2.4 billion of that.
That signals real institutional confidence building, especially after the SEC approved those in-kind creation and redemption mechanisms for the crypto ETFs.
Explain that again. Why is in-kind such a big deal?
Okay, so instead of swapping only cash for ETF shares, big institutions can now swap the actual crypto Bitcoin, Ethereum, directly for shares and vice versa.
Oh, okay. More efficient for them.
Much more efficient. It makes large trades smoother, improves liquidity, integrates it better into their existing trading systems. It's a game changer for institutional adoption, makes it feel more like trading stocks.
Got it. And we have concrete examples of this adoption.
Definitely. Look at BlackRock's IBIT Bitcoin ETF. After just 18 months, it climbed to be the third biggest revenue generator for BlackRock.
Third place in 18 months. That's incredible.
It really is. It validates that whole thesis about structural, long-term demand for digital assets. This isn't just retail hype anymore.
It's the big players moving in seriously.
Precisely. And the regulatory side is catching up, providing the clarity they need.
Like the Genius Act.
Exactly. That provides mandatory full collateralization, federal oversight for stablecoins, de-risking a key part of the ecosystem for institutions.
Important piece.
Critical. And then you see things like BlackRock filing to add staking capabilities to its Ethereum trust. That's the next step, right? Integrating yield generation directly into these regulated products.
Yeah, bringing it fully into the traditional finance fold.
That's the direction of travel. So what's fascinating here is how these things we've discussed, Fed uncertainty, the huge trade policy restructure, digital asset maturation, they aren't separate stories.
Right.
They're all interconnected. They're creating this really unique, complex investment environment we're in right now.
It requires a new way of thinking, doesn't it? Seeing the links.
Absolutely. Moving beyond the old silos and recognizing these interwoven forces.
So summarizing the market response, Bitcoin's institutional path seems intact, despite maybe some short-term consolidation.
I'd say so, yeah. The underlying trend is strong.
While dollar strength and trade worries support a more defensive stance in traditional assets.
That seems to be the play right now, yes. Investors seeking some stability amidst the shifts. And the fact that the tariff strategy is being implemented, despite those projected economic costs, it shows real commitment to this trade transformation.
They're sticking with it.
They are. And the market's resilience. It doesn't look like rejection. It looks like adaptation.
Adapting to the new rules of the game.
Exactly.
Yeah.
And that adaptation itself creates opportunities for those who understand the shifts. The market seems to be pricing in a new kind of normal for global economic relationships.
Understanding all this, it's not just for Wall Street types anymore, is it? It feels essential for anyone navigating the economy today.
I completely agree. This isn't just background noise, it's the foreground. It demands a deeper engagement from everyone.
Right.
And just remember, knowledge is one thing, but applying it, thinking critically, that's where the real value lies, especially now with so much information flying around. Question assumptions, look for those deeper connections.
Good advice. So, as you, our listener, go about your day, here's something to chew on, a provocative thought. Given that really unusual dissent at the Fed and these huge economic shifts from the new tariffs, how will the global economy truly recalibrate over, say, the next 60 to 90 days?
What comes next?
Yeah. And maybe more importantly, what underlying assumptions might we still be clinging to that need challenging in this rapidly changing world? Keep digging. Keep asking questions.
Stay curious.